Welcome to Universe's Total Portfolio Podcast. This is a series that covers topics relevant to institutional and professional investors, including asset allocation, portfolio construction, and risk mitigation. By featuring leading experts in the field, we aim to provide valuable insights that can help investors improve performance and achieve their investment goals. Today, we're pleased to have Eric Baggesen as our guest. Eric is the former Chief Investment Officer at Rhode Island State Pension Fund. Prior to that, he held managing investment director positions, running both asset allocation and global equities at CalPERS, the largest public pension fund in the United States. I was privileged to work for Eric during my days at CalPERS. So in today's podcast, we will hear about Eric's experience and approach to asset allocation and risk management, as well as his views on the formidable challenges facing public pension funds today. Welcome, Eric. It's great to have you on the show.
Yeah, well, thanks very much, Ron. Great to join you in this effort. It's been a long time since we've been able to interact very much.
So, Eric, I know you've had extensive investment management experience in the private sector. So, before we dive into our main discussion, could you tell us a little bit more about your background before you went to work for public pensions, and then why you decided to make the switch and move over to CalPERS?
Sure. Well, my experience in the investment industry dates back to around the early 1980s, when I was actually working as a fundamental security analyst at a small wealth management shop in Providence, Rhode Island, doing, again, fundamental security analysis, talking to company managements and trying to really divine what's going on with specific firms. And I did that work up through, I worked at that organization up and through the 1987 market crash. That experience in the market crash just, gave me a lot of cause to pause, if you will, about the direction that I was taking in my career. I became much more focused, I guess, or enamored with the concepts of really doing more quantitative management and understanding more about the market in general, in contrast to the specific stocks, securities. Following working at that firm in Providence, I joined a group at the Boston company, and that was owned by Shearson Lehman at the time. And that group was really focused on quantitative asset management. And my job there was positioning mutual funds that were being directed by Shearson Lehman market strategists, people like Elaine Garzarelli, Mike Sherman. My job was to build mutual funds that reflected their views on the marketplace in general. And I did that for several years, and eventually that group became Panagora Asset Management. So it became a spin out, partly owned by Shearson Lehman and partly owned by the Nippon Life Insurance Company. And Panagora was very much, and still is, a quantitatively oriented asset management firm. They did a ton of asset allocation type work, although my job there was really focused on mutual fund management and also some active security selection strategies in the U.S. stock market. I joined State Street Global Advisors in the probably the mid-1990s. The reason I moved to State Street was to become involved more with the international equity markets. Prior to that, my whole experience had just been in the U.S. market. And at State Street, my job was being a senior portfolio manager for their structured products group, really focused on emerging markets. So I was responsible for all of our emerging market exposure, and the country funds that we managed at State Street typically those were probably some of the largest exposures in emerging markets that existed on the planet at that time. And that's really where I got my first real significant exposure to the pension world, as a number of our clients were big U.S. and also international pension funds, as well as other asset managers that were using these funds to, in essence, make market calls and things of that nature. And I worked at State Street up and through 2003 and left at that time in 2003, partly because State Street was restructuring its organization. If you recall, that was the aftermath of the dot-com crisis, where the markets declined by almost 50%. And that had a huge effect on any asset management organization. So they were all feeling the pinch. And State Street, just as many other organizations did, really came to a decision to restructure the organization. I took a voluntary separation from State Street, partly partly just because it was time for a change in my own particular career, and also partly just because my mom happened to be sick at that time, and I was the only one in the family that could actually take the time to basically provide her with some care. And then following that, in 2004, I joined CalPERS, and eventually Ron, our careers at CalPERS coincided, particularly when we were working on the total portfolio activities in contrast to, focusing more on public equities or fixed income.
That's interesting, Eric. So obviously your career has traversed a path through a lot of major upheavals in equity markets. So beginning with the crash in '87, the dot-com bubble bursting, global financial crisis, and we have today, a lot of decision makers at funds that, are quite young and have not actually experienced events like that, aside from the turbulence we've seen in the market in the past few years, but that really pales in comparison to the dot-com bubble bursting or the global financial crisis. So I'm sure all that experience through that type of market turbulence has, influenced the way you go about asset allocation and risk mitigation. And that's what I'd like to get into. But, first, let me just kind of set the context. In terms of U.S. public pensions, we saw most of these public pensions near fully funded status before the global financial crisis. And I think CalPERS was an example of that as well. Okay, and then we had this big crash in 08, 09. Following that, we've had what's called the longest economic expansion in U.S. history, and sort of a coinciding bull stock market that's gone on literally for 15 years or so, aside from the declines in 2020 with the COVID pandemic, 2022 with interest rate hikes and inflation. There was quick recovery from those. So there's been this long economic expansion and bull market in the U.S. Yet the average funded ratio of public pensions to this day is still only about 75%, with many of those funds declining from fully funded status prior to 2008. So, I kind of want to come back to this theme as we talk about, what's going on at pensions, and then particularly, what are your views on risk mitigation? And another part that I want to get into is, obviously you and I work together at CalPERS, where we started to introduce sort of a new form of risk mitigation, tail risk hedging, which was not commonly done by public pensions. So, just to start, what is it that pensions do to determine their funded status? And what is it that they do in order to not increase contribution rates from employers, if that's possible? In other words, sort of what factors influence the decision to adjust employer contributions, and how do pension funds balance the need for sustainability, with the financial capabilities of the employers? Because these are things that are seriously impacted when you have these major drawdowns.
Sort of back up for a second. So, for one thing, basically, we have a pension world that is, it's not just populated by public pension funds. You've also got corporate funds that are guided by ERISA and all this. But a lot of this traces back to the actuarial processes that are used, in essence, because it's the actuaries that determine the funded ratio of all of these different plans. And that funded ratio is just an extrapolation of the liability structure, the benefits that have been promised to employees over time relative to the assets held by the plan, and also to some extent the structure of the asset allocation. One of the things that is a little bit of a chicken or egg kind of a construct is the assumed rate of return. Is that determined by the asset allocation, or is the asset allocation determined by the assumed rate of return that ends up being, adopted by these plans? Part of this is a part of what traces to the stress in the public fund space in particular is it's all linked to the governance process by which these organizations make decisions and bound themselves. If we trace ourselves back for a moment, to like CalPERS, for example, where you and I both shared our, significant experience. One of CalPERS's challenges were that, following a great market environment that existed mostly through the 1990s, partly due to declining interest rates and things of that nature, and leading up into the dot-com crisis, CalPERS, like a lot of other organizations, had a high assumed rate of return and a high discount rate. The discount rates for most public funds, got up above 8%. So part of the funded weakness that exists now is simply a decline in the assumed rate of return and the discount rate that is applied to the liability structure. So if you go from an 8% assumed rate of return and discount rate to a 6% assumed rate of return and discount rate, that will automatically move your funded status, more into negative territory, assuming that you were fully funded with an 8% assumed rate of return. That became one problem. Another problem that faced CalPERS and other organizations were that following a good market experience, benefits had been increased, and those benefits were increased retroactively. You literally had the promise being expanded without additional assets being added to the plan. So that in of itself also served to weaken the funded status of a lot of these plans. Again, that's not unique to any one specific plan. That seemed to, roll through the industry. That just became a real challenge. And then if you go back and you look at, for example, an S&P 500, just in a simple construct, a return stream for that, even a total return stream, you'll just see that literally from 2000, when the market peaked out with the dot-com crisis, the market didn't regain its valuation level for literally 5 or 6 years. It was mid 2000s basically before regained that process. So you literally had, if you were operating in a plan with an assumed rate of return and a discount rate of, let's say, 7% over that time period, your liabilities grow at 7% a year. If the market's going sideways, that runs you into an underfunded status very, very quickly. So that becomes again part of the problem. And the way that these plans operate, and you got into this when you asked the question about changes in contribution levels, particularly with public funds. These organizations and the sponsors of these funds do not have massive financial flexibility. Virtually every government entity that I've been exposed to operates, in the best case scenario, pretty much at a break even, in a best case. And in many cases, they're operating in a deficit. And that simply means that they don't have the latitude to ratchet up contributions dramatically in any one time frame. So when they make adjustments to the discount rates and things of that nature and the assumed rate of return, those adjustments are typically phased in over a number of years. So it takes a long time before the contributions actually start to roll in. Most of these plans turn around, and if they have an experience, so for example, if they're operating and assuming a rate of return of, let's say, 7%, if they generate a rate of return of 5%, they come in 200 basis points under their assumption. That creates automatically, an incremental liability. So most of these plans have now adopted amortization schedules, but those amortization schedules stretch out from 20 to 30 years. So that couple of points of underperformance literally will not be impacted into the discount rate and clawed back, if you will, in contributions, literally for a period of 20 to 30 years. And prior to some of the financial crisis stuff, many of these organizations actually just used a rolling 30-year amortization, which meant that they would never actually pay these things off. Every year they would establish a new 30-year amortization, pay 1/30th of it, and then just kick the can down and do another 30-year amortization the following year. Most of the weakness in these plans has been due to contribution problems, in contrast to rate of return problems. Obviously, they'd like to earn as much as possible with every investment dollar, but that has to be juggled against the volatility that potentially can come from just pursuing the highest rate of return.
Well, that kind of leads me to my next question. So it's been my experience, it seems to me that pensions have left a lot of money on the table over this period. Had they had higher allocations. There's been some studies that kind of look at the sort of factor exposures of pension funds, and they kind of show on average that they're essentially like 60-40 type allocation in de facto 60-40 portfolio stock bond. Granted, there are a lot of asset classes, private equity, private debt, and so forth, but in essence, the exposure to the market is analogous to something like 60-40 or maybe a 70-30 portfolio. So had they chosen more equity exposure over this period, obviously they would have done better. And granted, these pension funds still have to try to fund future liabilities. So, I understand that the problem with funded ratio stems both from the asset and the liability side. But nevertheless, if your required rate of return is 7%, and the S&P is up 25% in a year, is it really such a good outcome for your pension fund to be up 7% in that year? In other words, you sort of have to make hay when the sun shines. So, my feeling is that, pensions have, in the interest of controlling volatility, have taken on too much diversification, have diluted returns, sort of adhering to principles of modern portfolio theory. So this raises the question, how in your experience with asset allocation have you approached, this in terms of how you decide how much to allocate, how you decide how much volatility you're willing to endure, and how does that shape your view on how to mitigate, let's say, equity tail risk, which if we have another major drawdown, it's going to really hit pension funds hard again.
Yeah, I mean, it's a really good question, and what gets tough about this is that, well, when the asset allocation work is done, typically, in my experience, that at both at CalPERS and at the Employees Retirement System of Rhode Island, the asset allocation work we did hand in hand with the actuaries, and we would take potential asset allocation structures and relay that information to the actuaries, and the actuaries would convert that into risk factors that were then considered by the decision-making bodies at these plans. Because typically, again, that asset allocation and the risk tolerance, if you will, of these plans is not something that is generally decided upon within the staff. That was not a decision that you and I had, for example, delegated to us at CalPERS. That was a decision that went ultimately back to the CalPERS board. We would obviously have an input into the information that underlaid the board making that decision, but they were ultimately the decision-making body. And this is where you get back into the governance of these plans, a critical element in anything that happens with them, because the decisions are not just made by, people that have spent their entire careers in this area, such as ourselves, for the most part. Instead, it involves politicized boards that have many, many different objectives. But anyway, what the actuaries would do is they would take potential asset allocation structures and convert that into their estimates of volatilities. And they would then perturb, if you will, the structure of the liabilities and the funded ratio information, and they would create or calculate probabilities as to potential outcomes, which were always driven ultimately by volatility numbers, and to some degree correlation numbers, which, we both know that those numbers are not stable, over time. So there's a certain amount of obviously imprecision attached to all of this, but they would create probabilities that would be expressed in terms of the probability, for example, that an increase in contributions of something like 10%, over like a 5-year period. The funded ratio would, potentially move. Obviously, they'd like it to move in a positive direction, but there's also a probability that it could move in a negative direction, and the probability that that funded ratio would decline. It would be expressed in terms or converted into terms that the board could wrestle with and try to understand the potential impact on the entities that are ultimately making the contributions. At CalPERS, for example, even though we ran it as a single plan, there were over 4,000 employers that were making contributions to CalPERS on behalf of their employees. And each of those employers had a slightly different funded ratio, if you will. That was all the work that the actuaries were calculating. But anyway, the board needed to consider, the potential effect on both the retirees and pending retirees, but also on the sponsors of these things, that really make the lion's share of the contributions. So, but they tend to express those volatilities into things, again, such as the budget for being able to make contributions.
But just getting to a few other topics before we close. So what in your view would you call your greatest successes while you were at CalPERS? And what were some areas where you felt you could have done a better job.
I don't know. I'm not 100% sure about what successes I had, other than I don't know. I considered it a success to restructure the equity program to get rid of a lot of active management fees that were being paid. But even as I say that, I think CalPERS is currently engaged in an effort of rehiring some active managers, even though I have a personal high degree of skepticism that a plan that represents, I don't know, the equity exposure at CalPERS right now has to be around $250 billion, somewhere in that ballpark. And I have no idea why you would assume that you can find alpha with that kind of exposure. What I would say is that I actually view, I don't know, probably one of my greatest disappointments at CalPERS was the outcome of our experiment on tail risk hedging. And I personally feel responsible, for the outcome that happened in that instance, in the respect that, I mean, when we did that, we did it as an active bet. And that was an active bet that, resonated to us in asset allocation. I knew that that was a risk in the respect that if it wasn't built into the asset allocation, we ran the risk of exhaustion on, waiting for, a significant monetization event or whatever it may be, basically in the structure of governance at CalPERS. And that risk ultimately came to, fruition, if you will, in the shutting down of the program. And so I consider it, in essence, a failure in the respect that I wasn't able to maintain the experiment that we were running to answer the questions, to really figure out how to really build it into the structure of the asset allocation. Because if it's not in that structured asset allocation, it's extremely susceptible to being picked off. What's so interesting is that prior to the decision being made to unwind the tail risk hedge, and prior to, for example, the 2020, COVID experience, which would have, it's created a huge payoff for the tail risk hedge program. The media were spinning up articles about how on earth could CalPERS have these tail risk managers that earn nothing, and in fact, had generated massive negative returns against just the notional value that had been put into these accounts. So the media was spinning a story through the fall of 2019 about CalPERS, staff have lost their minds, basically having these managers that are, in essence, in their mind, the media's mind, losing money simply because, we were only funding these strategies with just enough to, cover the notional value of the options.
Yeah, well, yeah, I can remember that. Of course, they don't focus attention on other aspects of risk mitigation. So trend following, for example, is sort of considered a cornerstone, what's called crisis risk offset. So, you have a year like 2024, the S&P is up 25%, SocGen trend index is up 2.6%. Now, to get anything effective out of trend following, to protect you in a downturn, you're going to need 5, 10, 15% allocation. So you look at that return differential, 25 versus 2, that's an enormous cost. Anything that you spend on tail hedging, in my opinion, pales in comparison to that. Look at 2023, trend following is down 4-5%. If you look at the SocGen index, the S&P is up 26%. So that would be a very painful experience, I think, if we had a large allocation. But I don't think, we ever would have done that ourselves. But I do want to point out something that I think a big success that you had is that you were a driving force in getting CalPERS to change the way it was rebalancing the portfolio. We had basically had a monthly rebalance schedule. Whether we actually rebalanced monthly was another thing, but sometimes we allowed the portfolio to drift. But nevertheless, the benchmark had a monthly rebalance schedule. And we did some studies, you and I together, to show that was really not, there was no economic advantage to doing that. In fact, when you consider the fact that a pension fund is largely a stock bond portfolio, in essence, there's more of a tendency for these assets to drift over time, to trend rather than mean revert. and you're actually better off rebalancing, let's say, less frequently, or with what we called a band rebalancing schedule. And I think you were instrumental in helping us make that change. Because there's an article that just came out the other day, which shows that pension funds are being picked off and front run because of the regularity of the rebalancing schedule. So that's another disadvantage, certainly in telegraphing, your rebalancing process. But I think we also established that there's really no benefit to just constantly pushing the portfolio back to the strategic allocation. And in fact, we came up with a fairly interesting twist on that approach of band rebalancing that you came up with, which was to do sort of incremental rebalancing around, not have a firm threshold where, if you miss it, you don't trigger rebalance.
Yeah, I mean, look at that's one of the challenges, and the experience that I had at CalPERS versus Rhode Island, just because the plans were so different. CalPERS is whatever. At the time that I left, it was over $400 billion. Rhode Island is $10 billion. $11 billion. It's sort of like, the things that you could do in a place like Rhode Island relative to CalPERS, you could actually effectuate a change if you wanted to make it. I mean, when we were doing asset allocation work at CalPERS, and if we were making any kind of a material change in the structure of the asset allocation, I mean, that would typically involve a 1 to 2 year implementation period, just to try to be able to, all the decisions that get made are made in the court of public opinion. So you're telling the whole world what the heck you're doing. The only thing that you can then do is try to anonymize your activity over time and try to hide it, because you've already told the world what it is that you're going to do. And that's just a huge impediment. So I'm not at all a fan of, for example, tactical asset allocation, because that's, in my mind, just market timing. And I just don't know anybody who's done it well. Maybe a few successes here or there, but just not systematically. It just doesn't really seem to, be able to work.
I was going to bring that up as well, because I know we looked at that closely together, and we actually ran a program for several years where we had outside managers provide their recommendations for tactical asset allocation. We found that no value was added, at least over that period that we were experimenting with it. Again, not to say that someone out there doesn't know how to do it.
Yeah, I mean, look, and again, that's, if you were going to engage in tactical asset allocation, I mean, I could have a heck of a lot more sympathy for that effort if you were trying to do that in a place like Rhode Island with $10 billion, or, one of these smaller funds, in contrast to a place like CalPERS. To really move the structure of the asset allocation at CalPERS, you're talking about the movement of tens of billions of dollars of money. And the whole flipping world, is basically sitting there trying to detect, any entity that's entering the market with any kind of a position and strip the value of their information away from them. And it's sort of, so it just seems like an oxymoron when you get into these, monster-sized funds to try to do that, in that case. And that ultimately, it's one of the things, because there's so much out there that's worthy of criticism around things, such as modern portfolio theory, CAPM, all of the optimization stuff, the capital market assumptions that go into, the assumptions on this stuff, because there's so much imprecision and variability and risk attached that, I mean, your assumption on correlation, for example, if you set that up in the late 2000 teens, you would have assumed that the correlation between bonds and stocks was negative. And of course, that would have failed you miserably in 2022 when interest rates started to move and everything suddenly, was moving down together. There's such imprecision in this stuff. But at the same time, I'm not sure, going back to the governance structure of these plans, if you don't have some kind of organizing theory around this that at least tries to establish some sort of a baseline framework for doing this, I'm not sure how you would make decisions in these organizations, given that you're dealing with lay boards and everything else. So it's sort of, for all of the warts on capital market assumptions, modern portfolio theory, optimization, all the rest of that stuff, because it's sort of like optimization just, if anything, it magnifies the errors in the structure, but it's almost never really used in a pure sense, particularly in the larger plans, simply because you just can't implement that much. And you run the risk of, making a massive market timing decision if you move your asset allocation too much when you periodically mess around with things like capital market assumptions.
Well, one last question. So we all know that certainly over the past decade, even longer, U.S. equities have massively outperformed international equities. I think virtually every public pension in the U.S. has a mixed, diversified global equity portfolio. So, and some actually increased that exposure to international, sort of with hindsight, I think, looking at the period prior to the global financial crisis where US stocks were underperforming. And it's understandable. In hindsight, this was not a good decision. Obviously, had you been more heavily weighted towards US, but nobody could have foreseen certainly the impact of technology on US equities. What, in your view, could have been done about that? Should there be some discretionary input into rebalancing, not rebalancing so heavily back to the benchmark, let's say, for the international index?
No, that's a really good question, Ron. And honestly, look at it, that talking about the things that I guess I could turn around and lose sleep over and have regret about. Basically, part of CalPERS's international stock exposure was partly my doing. It's sort of like make no mistake of that. And that's one of the things when I was hired at CalPERS. I was hired to internalize the management of international stock exposure, and that had prior to that, it had all been farmed out to State Street, or active managers around the world. But it's a really good question, and I'm not 100% sure how to think about that, because it's sort of like I said, when I went to work at State Street in the early 1990s, mid 1990s. I went there literally to gain experience with the international markets, simply because I thought that, in essence, the globalization and, that no particular market had an absolute edge on anything. I mean, if the U.S. is just wonderful, then capital should just keep flooding in here until there's no more profitable things to invest in, basically. So it's sort of like, now that's a very simplistic viewpoint. The idea that no tree grows to the moon, right? It's sort of like at some stage of the game, you think that valuation, you think that, business, utilization or whatever has to take hold. And I think even some of the work that you've done in your capital market assumption paper, you looked at things like the CAPE ratio, right? The cyclically adjusted PE ratio. I think one of the outcomes of doing that review is that if PE ratios and valuations are high, forward-looking returns are lower. I think there's a negative, you correct me if I'm wrong, but I think there's a negative slope attached to that, to that viewpoint. So that would just lead you to the point. It's like, so the U.S. has had this terrific run. If you look at, as you said, there's been, nearly a 15-year bull market, pretty much, with just a few little hiccups along the way. Opportunities, I guess, for university to do some monetization and make some money with the tail risk stuff. But it's been an unbelievable time period. And should you assume now at this juncture that that's going to continue, and that the U.S. is going to continue to beat the pants off of everything else? I don't know. I mean, we'll see what the political winds, and tariffs and all the rest of this are gonna mix this up. But so there's a piece of me that after just because we've seen the experience of the U.S. beating the pants off of everything else. Does that mean that it's the U.S. forever? I don't know.
Well, I think we're coming close to the end of our time here. So on that note, I think this is a good place to stop. It's been great talking to you and hearing about your experience. And we'd like to get you back on the show.
It's great to talk to you, Ron. And look, I have a huge respect for what you and the folks at Universa do. Like I said, I think it absolutely is a element that, if I were making all the decisions, I wish I could put it into my own personal asset allocation, but I can't quite. You guys don't run a retail product for little people like me. it's and it's not as easy as just simply buying out of the money options, is it?
Great. Thank you very much, Eric.